Everybody. Good morning, EO Nashville. It is a privilege to, introduce our 13th installment of the hugely successful EO Exchange series this morning. And this one promises to be just as impactful as we have John with Compass East to lead us to find our one metric that matters. Keep in mind, in the last 15 minutes, we do want you to make connections just as we do in a live event before and after the event. So we'll place you in a small exchange group with some prompts to, questions to engage or generate conversation. And so we'll want you to stick around for that. And we'll also have a Q&A period. So if you have questions, just put them in the chat as usual, and we'll address those questions with John. So let me introduce you and tell you a little bit more about John with Compass East. In his role as CEO and co-founder of Compass East, John leads the strategic vision and culture development of the organization. He's worked with over 100 early stage and high growth companies across a variety of industries, including technology, healthcare, e-commerce, food and beverage, and real estate. A CPA in Tennessee, he received his bachelor's degree from the University of Miami. And outside of Compass East, John has been a big brother, as well as served on boards and committees of a few nonprofits in the city. And in 2017, John's 1996 backstroke record for 8-year-olds in Pennsylvania fell after 21 years. And since then, he has had 0 athletic accomplishments. So good job, John. All right, so let's turn it over to John. John and I go back a little bit. We were in Catalyst together in the same forum in Catalyst back in 2016, I believe. So looking forward to hearing, actually, just a side note, John, I created a little advisory board after Catalyst, and John was gracious enough to serve on that board for a couple of years. So appreciate you, man. But take it over, John. Look forward to it.
All right. Thank you, Bill. I had to really dig deep for that fun fact that Marla asked me for. So they're going back 20 years. So just want to make sure everybody can see my screen. All right. Okay. So today we're going to be talking about metrics. Obviously, the title of this is Getting to One Metric That Matters, but that is the end result of what all we're going to be talking about today. So it's going to be quite a bit of information, probably. So, just rest easy on that. So let me go through here. So our agenda, as I said, we're going to be talking about first connecting the metrics to your business model. How do metrics, relate to various aspects of your business? How do you balance those metrics when you want to look at those things? And then what are the fundamentals that you want to have in mind when setting up the metrics that you're going to track inside of your business? And then once you get there, how do you determine that North Star for your business, that one metric that matters when you want to get there? That is it's a process to get there, but how are you going to determine that? And then where do you start? Where do you go from here after our time here today? So first thing is the angles, affecting your business model. So in any business model, you've got a product or you've got a service or you have both, and you're delivering that product or service to a market, and your team is, involved in providing that product or service to the market. So when you look at your business model, these are your 3 core things. They're most fundamentally basic. When you want to look at how your metrics are going to fit into these things from a performance standpoint. So on the first thing, there's going to be 3 elements of fit on this triangle. So the first one is product market fit. So some of you in technology space have probably heard this a lot. If you've read anything about technology in the last 10 years, this is a very popular term. It's coined by Mark Anderson of Andreessen Horowitz, and he was the founder of Netscape. Basically, this is what drives everything in that technology space. Everybody is constantly focused on product market fit, meaning being in a good market with a product that satisfies the market. It's very, very basic. But this product market fit does not just live inside of technology. This expands to any business anywhere. You have to be able to have that appropriate product or service that is satisfying your market. And then the question is, how do you know if you have it? So there's quantitative approaches to getting there. So if we look at this product and so we go back to this triangle, what's our product market fit? You know, what does product market fit tell us? It tells us, what do we have opportunity to growth, opportunity for scale? And how do we start to look at that quantitatively? Is through growth accounting metrics. So growth accounting metrics, I think were first, made very popular by Social Capital, and then an offshoot to that, Tribe Capital. Silicon Valley, some of you have probably heard of Social Capital through Chamath Palihapitiya, who has become, highly popular in financial media these days through Bitcoin and SPACs. They've made this very popular in the evaluation of early stage companies. And it's also, these metrics are also very helpful for determining for any business that's looking at, are they driving product market fit? So some of those things that are highly important here are your revenue growth, obviously, is number one. So when you want to look at what are the quantitative metrics for that, how many new customers are you bringing into your business? What is your typical growth rate? Your growth rates for revenue could be month-over-month revenue. How are you? It could be year-over-year, meaning, if we're in June of 2021, how do we compare to June of 2020? And it could also be your annualized growth rate. What is your trailing 12-month growth rates over time? What's your expansion rate of customers? What's your churn rate? Your churn rate meaning your lost customers. Now, this could be for subscription-based businesses, or it could be for any type of businesses. If you are used to having 100 customers, do you have 100 customers every month? Is it 90? Is it 110? Where is the expansion versus lost customers? And then looking at your individual customer growth, how much is a customer worth to you? What are they worth to you over a lifetime? For most businesses, you don't want to just have your customer come one time, buy, and then never see them again. You want them to come back for recurring revenue. Every business is looking for recurring revenue from their customers, whether it's a set contract that it's like that, or they're coming back for different touch points to buy from you, because it's an easier process to drive more revenue from a customer than it is to go get new ones. So, and then how is that lifetime value growing over time? What's your net retention rate with those customers, and how are you expanding? And then lastly on here, what's important is your debt growth, comparing your revenue to your debt growth. So if you, a lot of businesses on the early stage or growth mode are raising equity or debt to drive that revenue growth. So what you need to be checking for is your revenue growth expanding and growing faster than your debt is growing. Because if it is, you got a healthy business model. But if your debt is growing faster than your revenue, then you're probably just buying revenue. And what that means is that in the long run, you're just going to be burdened by a huge amount of debt that you're just not going to be able to pay for if you're not growing faster than that debt is growing. So the next one on the triangle that we talked about is team product fit. So do you have a good team that can effectively sell and deliver your product and service? These are not complex questions. They're pretty basic questions here. So when we want to look at that, what are the quantitative approaches to looking at your product, your team product fit, or product team fit, however you want to call it? So this is where we talk about efficiencies in your scale. So your sales efficiency and your direct cost metrics. Like, is your team able to provide this appropriately? And what are the quantitative numbers to look at? So when we look at sales efficiency on a most basic level, we're looking at sales and marketing percentage of revenue. So, and when you do this, you want to look at these numbers on a trailing 12-month basis. So for most businesses that are probably on this call, everybody's probably had issues in accounting where they look at their financials and they say, well, from month to month, my numbers don't make sense. I've seen that with pretty much any business. One month, my sales and marketing was 20% of my revenue. The next month, it was 2%. And that's going to happen. And the reality is that you might spend your sales and marketing all at one time, and it's going to be hit in 1 month, and then you're not going to see it come much in the other months, or you're going to spend that sales and marketing ahead of the revenue coming in the door. And what you have to do is you have to look at those numbers on a trailing 12-month basis. Because if you look at a trailing 12-month basis, you get a whole holistic view of what you're spending versus that revenue. to actually get an accurate number of what that means, so that over time you're looking at your trailing 12 months, not your month to month, because that'll actually make sense to you. So then we break down into the little bit more complicated metrics. So customer acquisition cost. So this is taking that same sales and marketing cost, now divide it by the number of new customers that you acquired over that same period. And that essentially gives you how much it cost you to get one customer. So then from there, that number doesn't necessarily tell you much, because it could be really low, it could be really high. It all depends on your business model. But what does matter is looking at what's your lifetime value of the customer that we talked about with product market fit versus your customer acquisition cost. And you want to see that number. Obviously, you want to see that number in a positive, but you want to see that number 3, 4, and higher. Because when you get there, then that means you've got enough profit coming into the business after acquiring that customer to pay for the rest of your business. And if that number is going really high, what that might tell you is that you need to spend more money on marketing. You could spend more money on sales to actually drive more customers into your business. And if it's low, then it means you're just really inefficient, most likely, in your sales and marketing process. And you got to look at revamping that for your business model. So that's on the sales side. So on the direct cost side, gross margin percentage. So this most basic thing, you look at what's your target. Are you growing, declining on your gross margin? Your direct labor as a percentage of sales. Are your prices keeping up with your labor increases? Do you have the right people on board to deliver your product efficiently? And then purchasing power growth of direct materials. So what I mean by this is, if we take a look at your direct materials percentage of your revenue, you want to see that trending. You want to see that trending down over time, or at least staying the same. So for many of you, you might say, okay, for instance, I'm a landscaping business. And I know that my direct materials to service a job is 20% for whatever I might need. If I see that trending up over time, that might mean that there's something going on in the market where the material costs went up. Do I have to increase my prices for that? Or do I have to find a new way to get purchasing power as I continue to grow this business? And is my team delivering those, or is my team delivering those materials effectively as they're wasting that business? So those are the types of things that we're looking at from an efficiency scale on your business. So the last element of fit in the business model triangle that we're looking at is team market fit. So do you have a team that can scale with your market competitively? So this is going to be more about maturity. We talked about product market fit is kind of like where your growth is for opportunity for scale. It's going to be very important in the launch. Product team fit, team product fit, that's going to be much more about how do you grow your business effectively. And then team market fit, labor productivity, competitiveness. Once you have a solid grasp on these things, how are you going to be competitive in the long run so you can continue to maintain a profit? So the things that we want to look at there are going to be your labor productivity numbers. So there are many ways to do labor productivity. It could be revenue per employee, gross margin per employee. Very simple numbers of just how are you scaling your productivity based on your headcount. Labor efficiency ratio. Some of you have probably, this is actually pretty popular through a book called Simple Numbers. I think Greg Crabtree wrote it from Crabtree, which I'm CRI. So some of you have probably heard of them and heard these numbers before. So this is taking essentially what are you bringing into your business from a gross margin standpoint? How many dollars are you bringing in for every dollar you spend on your payroll? So is your team bringing in enough dollars to make profit? So that's a very simple term. You can basically look at those numbers across many different business models to see, how effective is your team at bringing in profit to your business. And then also realization and utilization rates. So this is pretty popular for service-based businesses. So if you have a service-based business and you're delivering revenue to a customer, how much of your team's time is actually spent on a chargeable project or on a client matter at all versus admin time? And you want to keep those numbers as high as you possibly can for your labor productivity. So then once you have a labor productivity number, then we're going to get into your competitiveness and how competitive are you in the long run. So the first element of that is the productivity growth. So let's say that we decide that revenue per employee is going to be our measure of productivity. So if I'm in June 21 and my revenue per employee was $100,000, and in June 2020, my revenue per employee was $50,000. So I've got essentially 100% productivity growth in that trailing 12 months. But then to look at how competitive you are, we have to look at your wage growth at the same time. So in that same time, my revenue per employee went up $50,000, 100%. But my wages, I needed to make sure that my wages didn't grow faster than my productivity. So if at the same time, my wages went from 50,000 in wages to 150,000 in wages, then that means that I grew 200% on my wages. So if I'm 100% on my productivity, 200% on my wages, not a good sign. But if my wages went from 50,000 to 75,000, they may have increased by 50%, but my productivity went up by 100. I'm still in good shape. So this is one of these things that you want to make sure. A lot of times people get scared that your wages are going up, and especially in a time like today, right now, with inflation happening, it's like, how am I going to pay for this in my business? Well, the wages going up is not necessarily a bad thing. What's bad is if your wages are going up faster than your productivity is. So you need to measure both of these numbers so you can see how that's occurring in your business. And then on other thing in purchasing power is looking at the remainder thing. We've talked about sales efficiency. We talked about labor productivity. So what remains on your P&L is your fixed operating expenses. So those are your G&A, your office supplies, your rent, utilities, insurance, overhead, professional services like legal and accountants and IT consultants. So if you look at the sum of all those costs, you look at them as a percentage of sales. We want to see that decreasing over time as we continue to expand our top line. And that's going to show that you have purchasing power on that aspect of your business as well. So that's a summary of what's the fits for a high growth capacity for scale. So when you're looking at your business, what's your product market fit? What's your team product fit? What's your team market fit? Do you have opportunity for scale? Do you have efficiency in that scale? And do you have competitiveness in that scale? So now that's one piece of the metric balance of looking at the actual performance. And you're going to pull a lot of this right out of your P&L or from your non-financial numbers as well. So the other thing that we're looking at that you need to keep in mind is cash. Cash is what's going to help keep your business alive as you are working on those metrics from your P&L standpoint. So there's three elements of the cash that we like to tell folks to pay attention to. So one is launch capital. So if you're a brand new business, you have a brand new division, you have a brand new location, sector of a business, you're entering any new market, new revenue stream, new project. We want to look at what you're going to take that capital before you actually have a significant amount of cash flow coming through that. We need to be cognizant of what's our burn, how quickly are we burning money on this, how many days of cash we have left, what's our burnout date. That's what's going to be most important when we look at anything that's pre-revenue in that standpoint. And like I said, it doesn't necessarily mean pre-revenue as a business. It could be pre-revenue in any new project that you're doing. So once you go through there, then we're looking at growth capital. So do you have enough capital to pay for expenses in the long run? So a couple popular ones that would look here is quick ratios. So how much cash do you have just divided by your current liabilities? Obviously we want that number to be 1 or higher. We want more cash than liabilities. I think current liabilities aren't books. Current liabilities, basic ones are going to be your accounts payable and your credit cards and any payroll liabilities. Those are going to be your most basic things. Do you have more cash than your debts are? And then your defensive interval ratio. This might sound like a new one to a lot of people, but also a pretty basic number. It's taking your cash plus your accounts receivable that you have on your books, the monies that are due to you, and then divide that by your average daily expenditures. And that's essentially, it's going to give you a similar number to days of cash on hand, but this time it gives you also adding in your AR, what you're expecting to get in the business. Why is this important? Very easy. If there was, I don't know, some kind of apocalypse scenario where like the government decided to shut down people for a couple months in a pandemic situation, you might need to know how many days can you operate without seeing another dollar of revenue coming to your business. So that's why this is really important for your growth capital. We've already just experienced something like that where it's super important to know how much we have, how many days of runway do we have at any given time. And then lastly, your opportunity capital. So one of the biggest things is like, as you are in typically, especially for businesses, most of you on the call in your business, like how do you save money appropriately or target and reserve capital for opportunities in the future? So the question we see, like, well, how do I know when I have enough capital to enter a new market or take advantage of a new opportunity? And one of some of the most basic scenarios that are basic elements that we try to calculate for people is, what is your targeted reserves? What and where do you feel comfortable with your risk? So if you don't know where you feel comfortable with, let's take 60 days of expenses. So if you take 60 days of expenses in your operating expense in your business, you add in any tax payments you have to make, and then add the current liabilities you have in your business. And this should be your targeted reserve number. Now you can change that to 30 days, 90 days, 120 days, depending on like how much risk you want to take. But this is a decent scenario. If you take these targeted reserves, compare this to your current cash, and that can tell you is essentially how much you have in opportunity capital. Then once you get to that point that you actually have a surplus over that target reserves, start creating a fund, a market, money market, a savings, anything that you want to put in, start putting that capital away in opportunity. Once you have that, essentially all of that then becomes a cycle. So you're launching a business, you're then growing, you're having capital to grow your business. It's becoming opportunity capital. That opportunity capital now you can redeploy in anything to launch a new product, new location, new business, anything that you want. And then you have this cycle, and your cash, and cash is king in all these scenarios. It's going to keep your business alive to allow you the opportunity to continue to create opportunities that we talked about for scale in your business model. So when we look at, we talked about today, first we talked about the fits, and now we talked about the cash. So you have to be, it's a challenging situation for business owners, but the reality is you have to look at both of these things, and they don't always, they do relate to one another, but sometimes they can be very different. So it can feel like, how do I grow my business when I have to keep cash on hand? And we just have to have a lot of balance here. So when we look at, what's the badge of honor essentially into a business, and how do we want to look at the business and balance in your business model is, looking at this kind of sphere of influence is that you've got your product and your service, you've got your market and your team, your product market fit, your team product fit, your team market fit, and then all the elements of capital that you need around that business at any given time. And all those metrics that we went through, and you want to keep a good, healthy balance among them. That's a lot of it's a lot of metrics to track, but all very necessary in determining an objective approach of where you are in your business. So where do we go from here? We're going to look at what are the, how do we come up with these metrics? So we've talked about, gave you guys a very long list there, and there's probably many more metrics that a lot of you probably have seen and heard before that you can put into those categories as well, and you can track endlessly amounts of numbers. But let's say once you get down to what are the metrics that you want to track, what are the fundamentals that we want for those metrics? So number one, any metric that you do, you want it to be simple. You want it to be easy to understand. And sometimes you just have to learn what it is up front so that you can understand it. So you want to keep it very simple. You don't want to have to do algebra to come up with what the metric is. You want it to be very simple math. You want these to be detailed. So defined. So for instance, gross margin, as an example, it should be very clear. It's revenue less cost of goods sold is your gross margin. Your gross margin divided by your sales is your gross margin percentage. So you just want these to be very clear and defined, so for anybody that you're sharing with understands these. Consistent. You want them to be, the calculation methods and the structure are same from period to period. This also goes to your accounting methodology and how you code and record transaction in your books each period. If you decide one month that you have a software subscription that you're going to put into direct materials in January, and then you decide to put it into operating expenses in February, well, now your gross margin percentage is going to be irrelevant because you started changing the way that you code expenses. So you have to make sure that you keep a consistent way of where you put your information so that these numbers continue to make sense. Universal, you want these numbers, whether you're looking at it from how these metrics, how you align with a market or your industry, or just a business at large. If you have multiple departments, like, does it make sense for the business that it's a universally approach to everybody? And then once you have these things and you want to start to, share these business models, you want to be transparent, take these metrics, whether it's 40 metrics, 4 metrics, 1 metric, what you want to do is you want to be able to use these to drive accountability on your organization. And you can't do that unless you're sharing them and being transparent. So those are the basic fundamentals that we want to look at when we're talking about, how to set these actual metrics. So we went through a long list of metrics, lots of different metrics that we can track, lots of different areas of the business, went through the fundamentals. Now we started this whole thing with how do you get to one metric that matters? So, and what is one metric that matters? So we're looking at, like, what's a North Star? So if you get down to a point of you feel very comfortable, I just want to have one metric, how do I get that? How do I get to that one metric that is relevant to me at any point in time? So that's essentially what we have to come up with questions. So how do these metrics relate to my revenue growth? So it's each metric I want to go through, and I want to select it from a list, or I want to create a new one. How's this metric going to relate to my revenue growth? How's it going to relate to my customers? How about my sales efficiency, my productivity? How does it correlate with my pricing? If I change my pricing, does my metrics change? How I deliver my product and service, does it correlate? Does it make sense for the people working inside the business that this is going to relate to their everyday activities of how they deliver your product or service? Where are you in your company's life cycle? So depending on where you are in a growth stage, early stage, expansion mode, maturity, that's all going to be dependent on what metric that you want to track for that North Star metric. For some of you, you might want to look at, like, how does this metric connect to my vision or connect to my mission as a whole? If I have a very grand vision for something that I want to look at, I might want to have something that is catered to our business and also reflects your core values. For instance, I've had know somebody who they were tracking their businesses works with counseling marriage and married couples and marriages. So their one metric that matters is obviously tied to revenue, but it's also looking at the number of marriages that they are saving. So that connects to their core values, it connects to their vision, which then effectively connects to their revenue and their profitability. And then at the end of the day, just for any entrepreneur, how does this affect to the value of my business? How is this going to increase my valuation at any given time? And then lastly, who's my audience? Who am I sharing this metric with? Am I sharing it with my team? Am I sharing it with my board of directors, my investors, my lenders? What's going to be relevant for sharing these metrics, and who's my audience before I decide what is one metric that matters? So elements of where you might think about what would be one metric that matters to you. So technology and subscription-based businesses. Often to see that if we want to break it down to one metric that truly does matter, net retention rate. Are you growing the value of your user, and are you keeping your churn low? Are you continuing to drive your subscriber base and people staying with you for a long time? That's going to be something that everybody in the organization can rally around in some way. How do you continue to retain your customers and expand the value of your customers? If you're in food and beverage or anything element related, gross margin percentage is going to be typically, the thing that's going to be most important to you. Now, there's two things that go into gross margin: cost of sales and your cost of labor. So your materials, if it's a restaurant, you're a food and beverage. If you're any other similar business, like what's the material cost actually, driving sales in the door, plus the labor that. So that's all going to go in your gross margin. How is that delivery model scalable for multiple locations and expansion? Because when you look at a business, a retail type business or food and beverage or any geographically focused business with a low comp wages, typically what you're going to find is that you only have so much availability in 4 walls. You can't expand revenue, from 5 to 10, just because you want to. So you have to look at, well, what's my gross margin? Can I expand this to other locations? Can I expand it to other markets? And that's how you're going to actually drive bottom line growth in your business from a valuation standpoint in the long run. If you're in the e-commerce space, customer acquisition cost is typically going to be very, very important. You know, you're trying to bring customers in from an online digital arena. Are you deploying your marketing resources effectively to drive down the cost of acquisition over time? So wherever you might be starting it, again, like we talked about customer acquisition, it doesn't necessarily mean if you're high or low, that number is not relevant immediately, but what is relevant is how it's trending over time. Are you bringing it down? And are you getting your customers to come back? So that could be a reorder rate that goes back to lifetime value. Are you getting your customers to come back in the door to drive the value in that e-commerce? And then if your professional services, revenue per labor dollar and realization rates are typically what I like to see as pretty popular. Are you monetizing your team's time? Are you actually getting full value for the expertise of your team deployed to a client? And are they spending their time wisely and not spending on admin? And for that's on the realization rate. And then for revenue per labor dollar, are you effectively pricing? Are you matching the pricing of your service with your team's expertise? So that's when we look at like how could you look at selecting these based on some different levels of business models. So now the other aspect could be, let's throw out business model and think about what stage we're in. So if we're an early stage business or an early stage, just that we're in a launch mode in our business, we're going to be most concerned with, just revenue growth rate. So it could be annualized revenue growth rate like I got here, or it could just be your month-over-month growth rate as you're launching a product or you're launching your service into a market. And basically your question that you're asking yourself is, are we getting money in the door? Are we finding any product market fit that people are going to want to continue to work with us in the long run? And we've got an opportunity to scale this in the future. And then if we're in the growth stage, lifetime value is really, what's going to matter. Once we have our first customers, do our customers want to stay with us? Are we increasing, or do they want to do more business with us? Are we increasing the value to our business, to our customers? And then that LTV CAC ratio, it's like, do we have proper margins, and are we acquiring those customers effectively? Are we deploying our sales and marketing resources efficiently so that we can continue to expand? And or do we have more money? Do we have more room that we could be spending a whole lot more in sales and marketing, but maybe we just don't have the capital and we just need to go get more capital so that we can spend more in sales and marketing to drive more customers in the door for a faster growth period. And then when we look at maturity, we've gotten to a stage where we feel pretty comfortable. We've rode out the launch phase, the growth stage. We're making good money on our bottom line. But now we have to look at, when we sit back and kind of like take a little bit of a backseat position, how do we continue to maintain that into the future? And that's where we talked about the competitiveness scoring. It's like our productivity, we've got a pretty solid way of getting business in the door, but how is our productivity and our wages climbing? Is our productivity staying at a faster clip than wages with inflation as we continue to take a little bit more of a backseat in that business with the maturity stage? So then lastly to this is, we talked about, how do you take one metric that matters from a long list of items that are kind of universal across many different businesses, whether it's, what industry you're in or what stage of business you're in. But now there's also, if you want to create one metric that matters specific to your business and you want to hit on your vision and your values, how do you do that? And here's an example from YouTube. So if anybody's read the book, Measure What Matters, OKRs, you probably have heard this example. But essentially what YouTube did in 2012 is looked at, how do they measure success? Do they measure it by dollars, or do they measure it by users? And when asking them themselves those questions, they got to a point of daily user watch time is really, that was the one metric that mattered to them. How do they increase the number of hours people spent watching YouTube videos each day? So once they got to that number, the value of that one metric that mattered is it refocused everybody's efforts. Everybody rallied around one number. You could set goals and benchmarks and measure and monitor consistently to constantly drive people in that North Star of where you're going with your business. So when they did that, they created their benchmark and their goal. and they set 1 billion hours in daily user watch time, which was going to be a 10x increase over 5 years. And they hit it about 2 months prior to when they threw out their stretch goal of hitting that in 5 years. Now, you might look at this and say, okay, well, they asked the first question, how do we measure success by dollars or viewers or number of views? And we might look at this and say, okay, well, how does this relate to anything? Well, when you come up with a metric that matters in this scenario where dollars and cents aren't directly in the metric, you have to make sure that it still will correlate to your P&L results in some way. And YouTube essentially did do that. Because if you think about watch time per user, if you've got longer watch time, you've got better content, you're getting more engagement. You get more engagement from your current users. That means they're going to be talking about it more and referring other people into YouTube. That means you get more users. You now have more attention. You got more touch points. Your advertising value goes up. Your revenue goes up. Your growth, your more profit, more opportunity capital. Now you can launch more markets and more revenue, and it's just overall more dominance. So when you look at creating that one metric, if you can find, when you get to that sophistication level where you can find one metric that it relates very well to your vision and values in your organization, and but you're gonna want to look at like the result of that. How does it affect each one of these things? Is it gonna push my revenue up? Is it gonna push my productivity forward? So these are the, as you get into that sophistication level, these are the type of things that you want to be, asking yourself in those questions that we talked about. So how do we start? So there was a lot of information that I just gave there. And if I were to, we've done this with lots of clients where we give them a full dashboard of all these metrics. Connect their books to the dashboard, and you give them a long list of metrics, and it's very overwhelming in the beginning. And frankly, there's a point for that. So the number one thing is you want to start this from the bottom up. And if you've ever talked with anybody from our organization before, you've probably heard us say this a lot. But what we mean by this is you need to actually have your data clean and accurate before you can do anything. So if you go and look at your financial records today and say, I don't understand them at all, then step one is go get them fixed. And because if you don't have records that make sense to you, then you'll never have KPIs that make sense. So you have to start there. Once you start there, then you take your list of KPIs and you can start to track as much as you can. So if you want to have a long list of 20 and 25, and all you want to do is for 3 months, 12 weeks, just track the numbers. Just put them in the list, just track them. Don't worry about, is this relevant for me? Like, is this the best one? You just do that for 12 weeks, 3 months, you're going to start to see a trend. And then when you start to see those trends come out, now you can start to look at, okay, well, what is best for me? What's most relevant for our business? What connects best to my team? So once you get there, then if you have a long list, then you can start to throw away the ones that don't matter to you. Filter out for the most relevant. And for most people, you're going to filter out to probably a handful, maybe 5, 7, 10. Some of you might get really, really ambitious and find one metric that matters, and that's all you're going to track and that you care about. But reality is most of you are going to want to look at a handful of metrics at least to drive business model health. So then once you do that, then you set goals around those. You continue to measure it. You continue to monitor, and then you repeat this process. So long way to get here. Lots of different metrics that you can track. Lots of different aspects of your business model. Your cash liquidity that matter, how to get to that one metric, asking questions that revert back to what stage you're in, what business you're in, who's your audience, and then how do I get there? I need to start with my data first. I gotta have clean data. I gotta track. I gotta see what a trend is. I can't. Everybody's here. We're all entrepreneurs, and we all have vision and everything. But you can't realistically think that tomorrow or after a meeting with a few people that if you've never tracked a KPI ever before in your life, that somehow you're going to know exactly what that number one metric that matters is tomorrow. So you have to start with the data and start to see what your numbers are telling you so that you can decide what number is going to be best for you to move forward. So that's it for me. A lot of information, I know. I think I might have went a little bit over the time.
Hey, John, no, you good, man. So I think we want to break out into groups in about 4 minutes. So if somebody has one quick question, I think we could get one question in about 4 minutes. And then going forward, there's his email address on the screen, and both John's actually. So if you guys can actually reach out to him if you have further questions going forward. I don't see anything in the chat yet. Real quick, John, okay, so somebody did say any thoughts on improving productivity. So what are some mistakes you may see in early stage or growth companies or mature companies, and how they try to increase efficiency? How can we increase productivity?
So typically when you look at like increasing your productivity, you need to first start with your process and your systems. So then you're going to go into the process and systems inside your company. So once you have detailed processes and systems that everybody has rules and checklists around, and you've got as much automation in your business as possible, you're going to see productivity go up. And then on top of that, you need to be thinking about your people. Are your people appropriately compensated to come to work and be productive? If people are worried about how do they pay for that healthcare expense that's going to come up that they don't have saved up for, productivity, that stress on individuals is going to drive down productivity. So those are the types of things that typically look at productivity. Start with system processes and systems, improve those as much as you possibly can. If you feel like your process and systems are in place, then you have to start looking at, your people as a whole. And do you have the right people in the right seat? Like, are they the right person for the job? And then from there, are you compensating people appropriately? And then on the last level, I would say, is your culture, like, do you have values and vision and culture that is driving people to an end zone that they care about? So those are kind of like the elements and stages I would take it in from driving productivity.
And then real quick, Jay asked about pre-built tools or apps, for calculating common KPIs. Any tools you see that are super efficient or effective?
So the thing with, so there's lots of tools out there. If you want something like really static for yourself and you're on QuickBooks, I would start with Fathom is a good tool. It's like, it'll just dump a bunch of stuff at you. And it may be relevant, it may not. There's Kavinci out there that is a dashboarding tool. There's Helm out there. There's Clipfolio is something that you can use to more like integrate daily dashboards. I could send a host of lists to people about KPIs now. But the biggest thing is that like most of these tools, they give you the ability to track anything you want, but you got to start with what do you want to track? So, we use another tool internally ourselves called Giraffe. And what we've done is it gives us a customization ability. So we have a blank canvas of what we can do. So when we tie it in there, we've got a custom dashboard of everything you're tracking, because the reality is we all want that really nice visual, pretty dashboard and things to get you, but that's step 2 or 3. Step 1, clean data. Step 2, figure out what those metrics are, put them on a Google sheet, like start there. And then once you track them, once you have them, then you know which ones you want to track and you want to make them more dynamic and pretty, then put them in the dashboard. And then you can choose any dashboard tool choose the dashboard tool that's best for you, because the biggest mistake I see anybody make is trying to make your business fit the software rather than make the software fit your business. So that would be how I would approach it.
Nice. All right. Appreciate you, John. Thank you so much. Again, his email is up there along with his partner, John. And please reach out if you want to discuss anything further. I think we're going to break out into groups now. And if you look